The Fed meeting looms on the horizon, and developments in traditional markets keep cryptocurrencies on edge as Volatility takes control of the situation. In this monthly time frame, we can clearly see that the zone between $47,000 and $37,000 has become the zone in which the price has been trapped since the beginning of 2022. The month of March was the second consecutive positive month, although the hammer candlestick formed in the superior part has a negative connotation, meaning it could be considered a hanging man candlestick. The closing of this month is very important, as we have been bouncing on the 20-period moving average, touching the average purchase price of whales on 2 occasions, and once again moving up to its current price. This average is acting as a support, and we will have to wait and see if it is lost when April closes, since it could lead us to a worrying downward movement. As we can see in the weekly time frame, we've been experiencing extreme volatility over the last couple of weeks. Bitcoin's price is now found in a lateralization phase. This is made clear in the week starting April 18th. We can see a shooting star candlestick in which it has opened in the $39,000 zone and managed to touch the $43,000 zone. Despite this, a great amount of buying strength flooded in and ended up closing with a bearish candlestick, returning to the inferior part of the $39,000 zone. This week, a doji candlestick is starting to form, maintaining the strong resistance zone in which the $39,000 zone is turning into. Despite this, its wick indicates the indecision experienced by the market currently. As mentioned in our last analysis, it has maintained the support at $37,800, in which also coincides with the 0.78 Fibonacci. With the deployed moving averages, we can see how the 20-period moving average is acting as a resistance, as it is unable to surpass it. The candlestick of the week starting April 18th, as we saw how it tested that average but was rejected. The current weekly candlestick also looked to test the zone between $41,000 and $42,000, but wasn't able to maintain that price. In this lateralization phase, we will see whether it consolidates the price to lose it, or, on the other hand, whether it looks to head towards the upside. This is a positive sign for now, as we haven't seen weekly candlesticks closing below the $37,000 zone, an incredibly important zone, as if it were to be lost, we would see greater drops. In the daily chart, the presence of volatility is very evident. On March 11th, a bullish movement kicked off up until March 28th. From then on, we saw how the price lost stability and dropped until the $39,000 zone. After losing 0.61 Fibonacci located in the $45,000 zone, we saw a movement with a bearish nature which the price has not recovered from. On April 11th, a full-body candlestick with a fairly negative connotation led us to the current zone, where a parallel channel was placed between $39,000 and $41,500. After losing that channel's support, it managed to recover it and return to the $39,000 zone, maintaining the trend line in which the higher highs and higher lows are marked. Volatility is easily identifiable when looking at candlesticks over the last 5 days. On April 25th, it opened on the downside, touching the $38,000 zone and continued increasing until reaching $41,000. On the 26th of the same month, the opposite occurred, opening on the upside, and after a short movement, it was rejected until reaching 0.78 Fibonacci, which converges with the current price's support. On April 27th, it managed to close on the upside, maintaining that movement throughout Thursday 28th and opening of this Friday 29th. If we deploy the moving averages, we can see how we're in a downtrend. The 20-period moving average crossed the 50 and 100-period moving averages on the downside, which is a sign of a short-term downtrend. To see ascending movements, we would have to see candlesticks closing above $40,000, which converges with the 20-period moving average, which is serving as a pivot zone. This would go on to test the current resistance located between $41,000 and $42,000 and coincides with the 50 and 100-period moving averages. On the contrary, we saw candlesticks closing below that ellipse. It could go on to test the inferior part of the downtrend, where the important support between $36,800 and $37,500 is found. In this SB500 CFD chart, we can see that volatility is also present in the traditional market. In addition, we can see how, when it touched the support zone, the movement was rejected, leading to a significant pullback and leaving behind the support located at 4,150 points, while it tried to test the 0.61 Fibonacci zone, which is found in the resistance between 4,270 and 4,300 points. In the dollar index weekly chart, or DXY, we can see an important infrastructure in which the price has gone on to test the 103,000 point zone, a zone which hadn't been reached since December 2016, which previously retested in March 2020. In addition, we can see an important structure, specifically a parallel channel, which at this moment marks the third test of a superior part of the channel. This could be seen as a triple top, but if it manages to reach the zone, said pattern would be invalid, being able to take this index to higher quotas. This graph shows us that the index that compares the behavior of the dollar against 6 major currencies in the world and generates a weighted average with the different values. This graph shows us the dollar's strength right now, which reflects the fear that exists in the market since the recovery of the dollar means that the sale of assets has increased to store liquidity in fiat money. This directly affects risk assets, given if the dollar gains strength, the risk asset market tends to decline. One of the defining factors that impact the market is a results calendar, where large companies register their quarterly income. Firms like Mitsubishi and Amazon generated negative results, and others such as Apple and MasterCard did not carry out significant ascending movements despite predictions. These results have an impact on the traditional market, which in turn affects risk assets, which are linked to cryptocurrencies. In addition, the inflation index of the United States affects global markets, specifically the movements of oil, power and natural gas, which continue to shoot up. This affects the decisions taken by the Fed to tackle this macroeconomic problem. This is one of the most important decisions. The Fed's meeting on May 4th is already looming on the horizon. The market has already priced in a possible 50 basis point rate hike following Jerome Powell's words. The decision that can mark the future of the market is not the upcoming rise, but how many there will be in the coming months and to what extent. This movement has a wide correlation with risk assets, which also produces a decline in the cryptocurrency market reflected in Bitcoin. To this must be added the reduction of 95 billion in treasury and mortgage bonds that are very negative signs for the market and could lead to a major recession if interest increases continue. Another development that is lingering around the market is the latest confinement in Shanghai, the capital of China, after suffering a new COVID-19 outbreak. This has caused the global supply chain crisis to worsen. This also leads to the increase in production costs, which in turn affects inflation directly alongside market stimuli. This could only lead to one possible outcome, which is the increase of interest rates to a greater extent and the acceleration of bond sales to try and alleviate inflation. The Fear and Greed Index continues to display a state of extreme fear in the market after having closed last week without crossing that barrier. In the on-chain analysis, we can see how the number of Bitcoins found on exchanges continues to drop, which indicates that holders are continuously purchasing and withdrawing Bitcoins, slowing down the fall of the price. In regards to contract options, something to keep in mind is that after winning today, the bears have prevailed over the bulls, since at the close of today, the price reached the area of $39,500. In addition, the max pain zone located at $40,000 was important for liquidity providers who were interested in the price being located in that price range to obtain profits. In the case that the zone of approximately $37,000 was lost, as we mentioned in the technical analysis, we're likely to see the continuation of the downward movement under the whale's purchase zone, which is located at $34,400. In short, the Fed's meeting and the volatility found in the traditional market leaves cryptocurrency market in suspense, with Bitcoin sitting at $39,000. We will have to wait and see whether after this meeting, fear takes over the market or, on the contrary, prices shoot up. We'll keep you informed here on MundoCrypto.